Imagine that it is October of 1930. You are a grain farmer in rural Nebraska. Your name is Harold. You have worked the same land for 30 years. You know the soil, you know the seasons, you know that good years do not last forever, and bad years do not destroy a man who has prepared properly. Last month, after selling your harvest, you deposited $4,200 into the First National Bank in your town. That money is not just a number on a statement. It is the seed money for next spring. It is the food money for your family through winter. It is the difference between keeping your farm and losing the only life you know. Then one Tuesday morning, you drive into town to withdraw $80 for supplies. You expect nothing unusual. You have done this many times. But when you arrive, there is a line outside the bank. People are whispering, some are angry, others are standing there silently with the look people get when they already know the answer but are afraid to say it out loud. The bank doors are locked. There is a handwritten sign taped to the glass, closed until further notice. You push forward, you knock on the door. A clerk inside looks at you, then looks down. He will not meet your eyes. He shakes his head and walks away. Your money is still inside. You can see the vault from the window, but you will never touch that money again, not $1. The bank has failed. Your deposit is gone. There is no insurance. There is no appeal. There is no hotline. There is no quick government rescue. And within 2 years, thousands of American banks will close their doors in the same way. People did not lose this money by speculating in the stock market. They did not lose it because they were gamblers. They lost it because they did what every responsible person had been taught to do. They deposited their savings. They trusted the institution. Then the institution broke. That is not just a story from the past. It is a lesson about how the system works. And if you do not understand the mechanics, you can mistake access for ownership, confidence for safety, and a bank balance for actual control. This is the point I want you to see clearly. When you put money into a bank, you are not putting your money into a sealed box with your name on it. You are lending money to a private institution. The bank takes your cash and gives you a claim. That claim says the bank owes you. But the money itself becomes part of the bank's balance sheet. The bank can lend it, the bank can invest it, the bank can use it as part of its operating machine. You become a creditor. And in a failure, creditors do not all stand in the same line. Some are secured, some are senior, some have special legal protection, some are connected to the plumbing of the financial system in ways ordinary depositors never see. You, the depositor, are not standing inside a vault with your money in your hand. You are holding a promise. Most of the time, that promise works perfectly. You swipe your card, the payment goes through, you transfer money, it appears in another account. You log into your bank app and see a number that feels like ownership. That is why most people never think about the legal reality underneath it. The system works so smoothly in normal times that the risk disappears from view. But disappearing from view is not the same as disappearing. That is one of the most important principles in understanding money and risk. A risk that is hidden is often more dangerous than a risk that is obvious. The common belief is simple. Money in a bank is safe. The building is solid. The brand is familiar. The government insures deposits. The Great Depression was almost a century ago. Surely the system has been fixed. There is truth in that belief. But it is not the whole truth. The system has been improved. It has not been made invulnerable. The names have changed. The tools have changed. The laws have changed. The language has become more sophisticated. But the basic machine is still built on confidence. And confidence is the load-bearing wall. When enough people believe the machine is safe, the machine functions. When enough people doubt it at the same time, the machine becomes fragile very quickly. This is what happened after 1929. Most people remember the crash as a stock market event. Black Tuesday, the Dow falling, panic on Wall Street, men in suits watching fortunes disappear. But the deeper economic damage came from the banking system. That damage did not happen in one day. It happened slowly, town by town, bank by bank, family by family. In 1929, the United States had roughly 25,000 commercial banks. They operated under fractional reserve banking. That phrase sounds technical, but the principle is simple. If you deposit $1,000, the bank does not keep $1,000 in the vault waiting for you. It keeps a fraction and lends out the rest. That loan becomes someone else's deposit somewhere else. That bank keeps a fraction and lends out the rest again. Through this process, one original deposit can support many dollars of credit across the system. This is how banking creates money. It is not a mistake. It is not a conspiracy. It is the design. And in good times, the design is powerful. It expands credit, it funds businesses, it allows mortgages, farms, factories, inventories, and growth. But the same structure has a weakness built into it. The bank's liabilities are short-term. Depositors can demand their money very quickly. The bank's assets are longer-term loans, do not come back instantly. Bonds may have to be sold at a loss. Investments may not be liquid at the exact moment everyone wants cash. That mismatch is the core vulnerability. Short-term promises, long-term assets. It works until too many people ask for their money at once. Then the mathematical truth appears. The money is not there in the form people imagine. It has been transformed into loans, securities, and claims on future payments. That is why bank runs are so dangerous. They are not just emotional events. They are mechanical events. If enough depositors line up at once, even a bank that looked healthy yesterday can fail tomorrow. And when one bank fails, the fear spreads. People at the next bank say, maybe I should pull my money before it happens here. That withdrawal pressure weakens the next bank, then another. Then another, the fear becomes self-reinforcing. This is how confidence breaks. In late 1930, the failure of the Bank of the United States in New York shook confidence badly. Despite its name, it was a private bank, not a government bank. It had hundreds of thousands of depositors. When it collapsed, the signal was clear. If this bank can fail, then maybe mine can fail too. And once enough people start thinking that way, the system begins to test itself. Between 1930 and 1933, more than 9,000 banks failed. The destroyed deposits were not abstract. They were business accounts, payroll accounts, savings accounts, farm accounts, family survival accounts. People had not made a speculative bet. They had trusted the system, and the system had more claims on money than actual money available on demand. That is the part that matters today. The lesson is not that all banks are bad. The lesson is that banks are leveraged confidence machines. When confidence is strong, they appear safer than they really are. When confidence breaks, they become less liquid than people assumed. After that collapse, the government created the Federal Deposit Insurance Corporation. The purpose was to restore confidence. If the public believed deposits were protected, people would not all run to the bank at once. If people did not all run, the banks would not fail in waves. If the banks did not fail in waves, the economy could stabilize. That was the logic. Originally, the insured amount was small. Today, the standard limit is $250,000 per depositor, per insured bank, per ownership category. Most people hear that and stop thinking. They say, I am covered. But again, good decision-making requires going one layer deeper. The FDIC is an insurance system. Insurance systems work well when failures are isolated. One bank fails here, another fails there. The fund steps in. Depositors are made whole within the rules. Confidence is preserved, but the fund is not designed to hold cash equal to all insured deposits at once. It is designed around probability. That is how insurance works. Not every house burns down on the same day. Not every driver crashes at the same time. Not every bank is supposed to fail at once. But systemic crises are different. In a systemic crisis, correlations rise. The things that are supposed to be separate become connected. The same interest rate pressure, the same asset price decline, the same fear, the same liquidity demand, and the same loss of confidence can hit many institutions together. When that happens, the question is no longer whether a fund exists. The question is whether the public authority behind the fund will choose to expand support, create liquidity, borrow from the Treasury, or allow losses to fall somewhere. That distinction matters. Deposit insurance is real, but it is not the same thing as infinite safety. In March of 2023, Silicon Valley Bank collapsed very quickly. A large share of its deposits were above the standard insurance limit. The government decided to protect all depositors because the failure created systemic contagion risk. That decision restored confidence. But it was discretionary. It depended on judgment. It depended on the risk regulators believed the failure posed to the broader system. This is not the same as a universal permanent guarantee for every depositor. In every institution, under every condition, that is the real point. If your money is above the insured limit, your outcome may depend on whether the failure is considered systemically important, whether regulators fear contagion, and what political decisions are made at that moment. That is not a prediction. It is a description of how the system actually works. And even if your money is within the insured limit, access can still be delayed. In a failure, funds can be frozen while regulators take control, transfer deposits, sell assets, or arrange a resolution. The money may be protected in legal terms, but access and timing are separate issues. In a crisis, timing can matter as much as the amount. If you need money for payroll, medical expenses, operating costs, or family obligations, a delay can become a real problem. This is why I always separate four things that most people combine into one word. Safety. There is credit safety. Will the money ultimately be paid back? There is liquidity safety. Can I get it when I need it? There is legal safety. What rights do I actually have? There is purchasing power safety. Will the money still buy what I need over time? Many people protect one and ignore the others. That is usually how they get hurt. The next lesson came in Cyprus in 2013. The banks there were under extreme stress. The rescue did not simply come as a traditional bailout. Depositors above the insured threshold were directly hit. Some uninsured deposits were converted into bank equity. Some balances were reduced. Capital controls were imposed. ATM withdrawals were restricted. International transfers were limited. This was called a bail. The word is important because it describes who pays. In a bailout, outside capital rescues the institution. In a bail, the people inside the capital structure absorb the loss. Shareholders are hit first, then certain creditors. Then, under specific rules, large uninsured depositors can be exposed. After Cyprus bail, rules became formalized in parts of the financial world. Regulators preferred this approach because taxpayer-funded bailouts had become politically toxic. It was easier to say that the bank's own investors and creditors should absorb the loss. At a high level, that sounds reasonable. But once you understand that deposits above insured limits can become part of that loss, absorbing structure, the risk becomes personal. Your deposit is not just money sitting passively in a vault. It is a liability of the bank, and liabilities can be restructured when institutions fail. This does not mean you should panic. Panic is almost always a bad decision. Making process, it means you should understand the machine. A person who understands the machine can prepare calmly. A person who does not understand it either becomes complacent in good times or panics in bad times. Both are dangerous. The practical question is obvious. If a bank account is not perfectly safe, where should cash be stored? I am not going to give you personal financial advice. That would depend on your circumstances, your liquidity needs, your tax situation, your country, your risk tolerance, and your time horizon. But I can walk through the mechanisms because understanding the trade-offs is the point. The oldest method is physical cash held outside the banking system. It cannot be bailed in. It cannot be frozen by a failed bank. It does not depend on a digital transfer working. It gives you immediate optionality in certain types of crisis that can matter. But cash has problems. It can be stolen, it can burn, it earns no interest, and if inflation is high, it loses purchasing power every year. In a deflationary collapse, physical cash can become more valuable because prices fall and liquidity is scarce. During parts of the Great Depression, cash was powerful. But in inflationary collapses, paper currency can become a terrible asset because the unit itself is being destroyed. The question is not whether cash is good or bad. The question is what type of crisis you are preparing for. A deflationary banking shock and an inflationary currency shock are not the same thing. They punish different assets. They reward different forms of preparation. Another option is treasury securities. When you buy treasury bills, notes, or bonds directly, you are lending to the federal government, not to a private bank. In the dollar system, treasuries sit at the center of the collateral architecture. They are treated as among the safest dollar-denominated assets because they are obligations of the government that issues the currency. Holding short-term treasuries can reduce exposure to a single bank's balance sheet. That is a real structural difference. But treasuries also have trade-offs. If you hold them through a brokerage, you now depend on the brokerage infrastructure. There are protections. But the process in a failure may not be instant. If you hold them directly through the government, you reduce intermediary risk, but access and usability can be less convenient. Selling quickly may not feel as smooth as moving cash from a checking account. So again, one risk falls and another appears. There is no free, riskless position. There are only different risks. Money market funds are another common place people put cash. Like money, they are not bank deposits. They are securities that hold short-term debt instruments. They may feel like cash because they try to maintain a stable value and can often be accessed quickly. But history shows that they can come under stress too. In 2008, a major money market fund broke the buck after exposure to failed credit. Investors panicked. Redemptions came under pressure. The government stepped in to stabilize the market. That intervention worked. But once again, the lesson is not that all money market funds are unsafe. The lesson is that cash, is not the same as cash. A claim that feels liquid in calm times can behave differently under stress. Precious metals are another part of the discussion. Gold has been a store of value for thousands of years because it cannot be printed by a central bank and does not depend on a corporate balance sheet. It exists outside the banking system if held directly. That gives it a special role in certain crises, But gold also has risks. It produces no income, its price can be volatile, it has storage and security issues, and history includes a very important warning. In 1933, the United States government restricted private ownership of monetary gold through Executive Order 6102. Citizens were required to turn in certain gold holdings in exchange for paper dollars. This happened. So the principle is simple. Even assets outside the banking system exist inside a legal system. Legal risk is real. Storage risk is real. Liquidity risk is real. Gold reduces some risks and introduces others. Silver and other metals bring their own trade-offs, often including more volatility and less convenient storage. Foreign accounts and foreign currencies can add another kind of diversification. If all your money sits in one country, one currency, one banking system, and one legal regime, then you have concentrated jurisdiction risk. Holding some assets in another strong legal environment can reduce that concentration. But this is not simple. Foreign accounts bring currency risk, tax reporting requirements, legal complexity, and compliance obligations. For Americans, foreign accounts above certain levels must be reported. Failure to do that can carry serious penalties. So this is not something to do casually or secretly. It must be done transparently and legally. The point is not to hide money. The point is to understand that jurisdiction is a risk factor, just like credit, liquidity, and inflation. Real assets are another category. Land, property, productive assets, and essential commodities are not bank deposits. They cannot be bailed in. They cannot disappear because a bank's liability structure is impaired. They have some form of physical or economic utility, but they are not liquid. You cannot use a farm to pay a medical bill tomorrow morning unless someone is willing and able to buy it. In inflationary environments, real assets can protect purchasing power. In deflationary environments, when credit contracts and buyers disappear, real assets can fall sharply in price. So again, the key is trade-offs. The dangerous idea is that there is one perfect place where money is always safe. There is not. There are only baskets of risks. Some risks are obvious, some are hidden, some are legal, some are operational, some are inflationary, some are behavioral. The goal is not to eliminate risk. That is impossible. The goal is to avoid being ruined by one failure point. That is what diversification really means. Diversification is not just owning many stocks. It is not just having several accounts at the same bank. It is having different types of exposure that do not all fail in the same way at the same time. This is where most people misunderstand safety. They think safety means trusting the strongest institution. But even strong institutions are part of systems, and systems fail in patterns. In 1929 through 1933, the people who suffered most were often ordinary depositors in small towns. They did not have political power, they did not have legal teams, they did not have early warning systems, they did not have multiple banking relationships or access to sophisticated alternatives. They had trust. Trust is good in human relationships, but trust is not a risk management strategy. In Cyprus, uninsured depositors took direct losses and ordinary people faced capital controls. In Argentina in 2001, bank accounts were frozen in the Corralito, and deposits were forcibly converted in ways that damaged purchasing power. In Iceland, after the banking collapse, capital controls lasted for years. In each case, the lesson was similar. When a system becomes stressed enough, the rules can change. The claim you thought was liquid becomes restricted. The money you thought was yours becomes a line item inside a political and financial resolution. The currency you thought was stable becomes vulnerable. This is why studying history matters. History does not repeat mechanically, but systems produce familiar outcomes under familiar pressures. When leverage is high, confidence matters more. When liabilities are short and assets are long, runs matter more. When deposits exceed insured limits, legal hierarchy matters more. When governments fear contagion, emergency rules matter more. When inflation is high, purchasing power matters more. When debt is large, policymakers face difficult trade-offs. Understanding those pressures lets you prepare without pretending you can predict the exact date or trigger. Preparation is different from prediction. Prediction says, I know what will happen. Preparation says, I know I do not know what will happen, so I will build resilience. That is a much better principle. Now look at the modern system. It is more complex than it was in 1930. It is more regulated, but also more interconnected. There are derivatives, wholesale funding markets, money market funds, brokerages, payment systems, shadow banking channels, and emergency central bank facilities. A failure can move faster because money moves faster. In 1930, a bank run involved people standing in a physical line. In 2023, a run could happen through phone calls, apps, messages, and wire transfers in a matter of hours. The technology changed, the human behavior did not. Fear still travels faster than facts. Liquidity still disappears when everyone wants it at once. Confidence still holds the machine together. Silicon Valley Bank showed this clearly. The bank held a large portfolio of securities. When interest rates rose rapidly, the market value of those securities fell. Those losses were not necessarily realized immediately. They could sit on the balance sheet as unrealized losses. But when depositors wanted money, the bank had to create liquidity, selling assets at a loss damaged capital. That damage created more fear. The fear created more withdrawals. The withdrawals forced more stress. Then the institution collapsed quickly. The mechanics were old, only the speed was new. This is the deeper problem with duration mismatch. If a bank owns long-duration assets funded by short-duration deposits, rising interest rates can create hidden losses. If depositors stay calm, the bank may be able to hold those assets and wait. If depositors leave quickly, the losses can be forced into the open. That is why accounting appearances and economic reality can diverge for a while. The loss can be hidden. It is still there. The system can be calm. It is still fragile. That does not mean the whole banking system will fail tomorrow. That is not the point. The point is that a person who believes the system has no fragility is operating with a false map, and a false map is dangerous in a storm. So what should a prudent person do with this understanding? The answer is not to run to extremes. Extremes are usually emotional, not principled. The answer is to examine your exposures. How much of your liquidity is dependent on one bank? How much is above insured limits? How quickly could you access funds if one account were frozen for several days? Do you understand the ownership category of your accounts? Do you have money in different institutions? Do you have any assets outside the banking system? Do you understand the risks of holding cash, treasuries, money market funds, metals, foreign currency, or real assets? Do you have records, access instructions, and a plan your family can understand? These are practical questions. They are not paranoid questions. They are the same kind of questions you ask about insurance, health, estate planning, or business continuity. The time to understand a system is before it is under stress. Once everyone is in line at the bank, the opportunity to think calmly has already passed. This is why I say the biggest danger is not a bank failure by itself. The biggest danger is being forced to make decisions under pressure, because you never built optionality when things were calm. Optionality is the ability to choose. When your money is trapped in one place, you have less choice. When your liquidity depends on one institution, you have less choice. When all your wealth is in one currency, you have less choice. When all your assets require functioning markets to sell, you have less choice. When you have prepared multiple channels, you have more choice in financial life. Optionality is often what separates survival from forced selling. This is the same principle that applies across markets, economies, and history. Good times encourage concentration, bad times punish concentration. Good times make liquidity look unnecessary, bad times make liquidity priceless. Good times make counterparty risk feel theoretical. Bad times make counterparty risk personal. Good times make people say, why would I need a backup? Bad times answer the question if you study crises. You see that the people who do best are not always the people who predicted the event. They are the people who did not need to predict it perfectly because they were prepared for a range of outcomes. They had liquidity, they had diversification, they had records, they had legal clarity, they had some assets that were not dependent on the same failure point. They had patience because they were not forced to act immediately. That is how you protect yourself from complex systems. You do not need to know exactly how the next crisis begins. You need to know what parts of your life break if one assumption fails. One assumption might be, my bank will always open tomorrow. Another might be, my deposits will always be immediately accessible. Another might be, the government will always protect every depositor. Another might be, inflation will not erode my cash. Another might be, my brokerage will always function smoothly. Another might be, the rules will not change when the system is under pressure. When you write those assumptions down, you can stress test them. You can ask what happens if one is wrong. That is how risk management works. It is not fear, it is clarity. And clarity is what most people lack because the system is designed to feel simple from the outside. Open an account, deposit money, swipe the card, trust the app. But underneath that simplicity sits a chain of obligations, assets, liabilities, liquidity assumptions, legal priorities, insurance limits, emergency powers, and policy choices. You do not have to become a banker to understand it. You just have to understand that your bank balance is a claim, not a pile of cash. Your access is a service, not an absolute law of nature. Your deposit insurance is a rule with limits, not a magic shield. Your cash has purchasing power risk. Your alternatives have trade-offs, and your best protection is not one perfect asset. It is a system of resilience that is the practical lesson from 1929. Harold did not fail because he was foolish. He failed because he was exposed to a system he did not understand. He trusted a local bank because that was what responsible people did. The tragedy is that his behavior was rational according to the public story and dangerous according to the hidden mechanics. That gap between public story and hidden mechanics is where many financial disasters live. The public story says your money is safe. The mechanics say your money is a liability of an institution that depends on confidence, liquidity, and solvency. The public story says insurance covers deposits. The mechanics say insurance has limits and systemic crises require policy choices. The public story says crises are rare. The mechanics say fragile structures can appear stable for a long time and then change suddenly. The public story says cash is safe. The mechanics say cash solves liquidity risk but creates theft risk and inflation risk. The public story says gold is safe. The mechanics say gold solves some counterparty risk but creates storage, legal, and volatility risk. The public story says real assets are safe. The mechanics say real assets can preserve value but may not provide liquidity when you need it. The public story says just trust the system. The mechanics say understand the system first, then decide what level of trust is reasonable. That is the Dalio principle here. Reality is the machine. Pain comes from not understanding the machine. The machine does not care what story you believe. It only responds to cause and effect. If a bank has more immediate claims than immediate cash, and enough people demand cash, the bank faces a liquidity crisis. If assets must be sold at a loss, liquidity becomes solvency. If many institutions hold similar assets, idiosyncratic risk becomes systemic risk. If policymakers fear contagion, they create emergency support. If emergency support expands money and credit, future inflation risk may rise. If they do not support the system, defaults and losses may cascade. There is no painless path. There are trade-offs. That is why smart preparation is not about ideology. It is about balance. Keep enough liquidity to handle disruptions. Avoid keeping unnecessary amounts above insured limits in a single institution without understanding the risk. Know the difference between a bank deposit, a treasury, a brokerage asset, a money market fund, physical cash, precious metals, and real assets. Do not treat different instruments as if they are identical just because an app shows them all as numbers. Numbers on screens can look the same. Legal claims underneath them can be very different. And when stress comes, those differences matter. I want to be very clear, this is not a call to abandon banks. Modern life requires banks, businesses require payment systems, families require checking accounts, retirees require deposits, investors require brokerages, the economy requires credit. The banking system creates enormous value. It also creates fragility. Those two things can be true at the same time. A mature investor can hold both truths without becoming emotional. The wrong response is blind trust. The wrong response is blind panic. The right response is informed diversification. Understand the limits, understand the hierarchy, understand the access risk, understand the purchasing power risk, understand the legal structure. Then build a financial life that does not depend on everything working perfectly all the time. That is the central lesson. When the bank doors are open, everyone feels safe. When the doors close, only structure matters. Only prior preparation matters. Only the choices you made before the crisis matter. History is full of people who discovered this too late. The farmer in Nebraska, the depositor in Cyprus, the family in Argentina, the business owner waiting for access during a bank resolution, the startup with payroll trapped in a failed bank, different eras, different countries, different terminology, same pattern. A claim that looked like money became uncertain under stress. A system that seemed permanent became conditional. A rule that seemed protective had limits. The purpose of studying these stories is not to become fearful. It is to become realistic. Reality gives you choices. Illusion takes them away. You do not need to predict the next banking crisis. You need to know what your plan is if one occurs. You need to know how much cash you need for immediate needs. You need to know where your deposits are. You need to know which amounts are insured and which are not. You need to know whether your assets are claims on a bank, claims on a government, securities held through a broker, physical property, or something else entirely. You need to know what can be frozen, what can be delayed, what can be inflated away, what can be stolen, what can be difficult to sell, and what can be accessed under stress. That is not paranoia. That is adult financial responsibility. The people who suffer most in crises are often not those who took the most obvious risks. They are the people who unknowingly concentrated all their risk in one assumption. My bank will always be there. My money will always be accessible. The government will always act in time. The currency will always hold value. The rules will always remain the same. The lesson from 1929 is that assumptions can fail. The lesson from modern banking crises is that they can fail faster. Now, the lesson from deposit insurance is that protections matter, but limits matter too. The lesson from bail-ins is that creditor hierarchy matters. The lesson from cash, treasuries, money markets, metals, foreign accounts, and real assets is that every refuge has a cost. And the final lesson is that resilience comes from understanding those costs before you need the refuge. A bank is not a vault, it is a counterparty. A deposit is not a physical pile of money, it is a claim. Insurance is not infinite, it is conditional. Liquidity is not guaranteed. It depends on the state of the system. Confidence is not permanent, it can break. But preparation is possible. That is what I want you to take away. Do not wait until the sign is taped to the glass. Do not wait until the line forms outside the door. Do not wait until regulators explain what you can and cannot access. Do not wait until the rule that protected you yesterday becomes the limit that traps you tomorrow. Learn the structure now, build optionality now, diversify intelligently. Now keep your decision-making calm now. Because once the crisis begins, you do not rise to the level of your hopes. You fall to the level of your preparation. And in money, as in life, preparation is the difference between being forced by the system and being able to choose your next move.